it's really not surprising that given what happened 10 years ago, and we're talking a lot about that today, that people might be getting a little nervous, wondering what's happening to their savings and whether this is happening all over again.
Yeah, you know, the markets over the last 2 weeks have had some very large moves. They've been very dramatic and eye-opening. And the one thing that we can conclude from this is that volatility is back. Now, when I think about 2008 versus 2018, it's interesting in the sense that it's 10 years apart. But if we go back to 2008, another interesting fact is that there was a mini crash, or not really a mini crash, it was the internet bubble crash in 2000. So in one decade, there were two significant stock market events, 2000 and 2008. And at the time, it was really an aberration. You know, we thought, well, that will never happen again. And here we are 10 years later thinking, well, maybe that's a possibility, and you certainly can't discount it.
So many people are still hurting, but you said if you really look at it, what's happening now has more similarities to 1987. And there was the big, was it a Thursday drop or something?
Yes, the largest stock market drop on record was Black Monday, October 19th, 1987. The stock market lost 23% of its value. Now, the market levels were significantly lower, so the stock market actually only lost 500 points, which is interesting considered we've had 2 days in 2018 where we've lost over 1,000. So levels have something to do with risk. But I do think that there is some greater similarities between 1987 and 2018 versus 2008 and 2018. And let me just kind of go through that a little bit. So in 1987, following the market crash, President Reagan commissioned a study done to investigate what the causes were of the market crash of 1987. That became known as the Brady Commission. They published a report. There were two market forces believed to, at a minimum, be a catalyst for the market crash, and maybe at worst, they were the cause of the market crash. So those two forces were program traders and portfolio insurers. And let me describe what those are. So program traders back in 1987 were pioneers in the concept of electronic execution. So they would use computers, review the market, review their portfolios. The computers would make decisions, and they would link directly to an electronic trading system and execute. And that was unprecedented.
Yeah, now it's done every day, but that was the trailblazing?
That's right, that's right. Every day, and you and I do it if we're buying stocks. We all do it now today. So electronically, that's how trades are executed today. The second strategy was this strategy called portfolio insurance. And I won't really describe what it was intended to do, but I can describe what it did. So when the market would rise, the strategy would buy, and when the market fell, the strategy would sell. And the concern was the market falls, portfolio insurance, which was widely followed, would sell the market, causing the market to go down again, and they would sell and continue, and this would create a vortex that would suck everything down. Today we have certain, well, number one, in the electronic space, as we mentioned already, everyone trades electronically. So the speed at which decisions can be made and the speed at which they can execute is unprecedented. Microseconds is what it takes to make trades now. The second thing is that there are a number of different strategies out there that we would call them trend following or momentum. So if the market's going up, we buy, and if the market's going down, we sell. And in particular, there's a certain class of an ETF, which are these leveraged ETFs, and you can get 2 or 3 times the return in the S&P 500. And those absolutely do something very closely associated with portfolio insurance in the sense that they're buying on the way up and selling on the way down. So I think there's some interesting similarities. Now that said, in no way am I projecting that we're going to have a 23% decline in the marketplace, but there are some interesting similarities.
The people can take solace in the fact that it's not necessarily this volatility based on the economy going bad or some of these companies that are being traded as having something going on in the company. It's really kind of strategies.
Yeah, you know, what's happened with these quantitative strategies and the electronic execution, to some extent we've gotten away from fundamentals. So if you look at the fundamentals in the economy right now, we have record corporate profits, we have low unemployment, we have relatively low interest rates. Now interest rates are going to rise a little bit, but it's still a great environment. The U.S. is really, firing on all cylinders, and globally, all of the countries are quite robust. So those things are all really fantastic, and yet we see this volatility going on in the marketplace, and we're scratching our heads trying to figure out, like, why is that happening? One of the reasons that I think it's happening is because the indices themselves are much higher. And for instance, this morning, I saw on the news they were saying, oh, Dow's going to open down triple digits, 100 points. And 10 or 20 or 30 years ago, a 100-point drop would have been significant. But today, a 100-point drop is really like 0.4%. So I think what we have to do mentally is reset our mind around what is a big loss. Now, 1,000 points is clearly a big loss, but actually, if you look at it in percentage terms, it doesn't even rank in the 20 worst trading days in the history of the stock market. And
especially when you talk about that 100-point drop, it could be 100 points up by noon on the same day. Literally.
Yes, that's right. The volatility intraday is what is so amazing. And I think part of what's causing that is the electronification of the market. So we have different players in the marketplace that are tied to trading systems electronically. Computers can make decisions, as I said, literally in microseconds and execute. Whereas in the past, when we had to look at a screen and make a decision and make a phone call, I mean, that on a good day would take 10 or 15 seconds.
Yeah, it slows you down at the very least. Yeah. Now, other people are talking about the possibility of inflation and a new Fed chairman also figuring into this. Would you agree?
Well, what's interesting, similar to 1987, there were concerns about that. We had a new Fed chairman that came in 1987. Guy by the name of Alan Greenspan, who held that post for many, many years. There were concerns about inflation, rising interest rates, widening trade deficits, and then a weakening dollar. And those things are somewhat similar. When people are concerned about inflation today, what they are concerned about is the speed at which interest rates will rise. Now, the one thing that I will say about central banks today versus, say, 10 or 30 years ago for sure, is that while they're not doing things in unison, they have very, very good communication, better than they ever had before, because I think going through the financial crisis, they realized that we're all in this global market community together, and if one country is doing very well and changes things, that has ripple effects throughout the whole system. So I have very good confidence that the Fed and their counterparts in Europe and in Asia are coordinated in the sense that nothing really silly is going to happen.
And kind of to conclude, do you expect it to keep this level of trading and volatility, or what is going to change to make it slow down and go back to what we call normal?
Yeah, well, I think, as I said, that the fact that the indices are at high levels, we are just going to have to get used to triple-digit moves. That's going to be the norm. The speed at which it's occurring, those are technology-driven, and Pandora's box is open. We can't put it back in. So those things we're going to have to live with. I do think as investors, what we have to be mindful of is there's nothing really special about a market close. A market, it's open throughout the day, and the value of my portfolio changes. So I think part of it is mindset and getting used to the impact that technology is happening in the market.
Very interesting. Okay, thank you very much for joining us.
Thank you.